All right, Bulls and Bears, we are back. Thank you for coming back to the channel. I did take, was it 2 days since I put out a video? 2 days. I apologize. It's been a couple days, I think. I am back here with another dose of you know what. Let's go ahead and get right into it. We've got a lot of news to get caught up on. This economy continues to be pumped up on easy money, basically the economy being flooded with cash. And some people say there's a contraction in the money supply, just the opposite. The money is pouring into the economy like we've never seen before. Look at the national debt. The national debt is borrowed money that gets put into the economy to keep this whole scheme going. And it's similar to a Ponzi scheme where you have the people at the top that got in first, the top of the pyramid, and it needs continually new investors or suckers to get in at the bottom and continually prop up, the people at the top. And once the new money stops being pumped in, basically like a Ponzi scheme, then the entire thing comes coming down. So what do we look at when trying to determine if and when this economy is going to take a turn south and we start seeing deflation and crashing markets, bursting bubbles, housing bubbles? All you have to do is look at the money being pumped into the system. And until something disrupts that, like we saw in 2007, 2008, then you're not going to see much of a pullback. In fact, if this continues, inflation is going to be the bigger worry versus any sort of market crash or deflation. But yet we still have people out there, a lot of them actually, thinking that everything is just fine, that the economy's strong because they look at the stock market, not realizing that the stock market is at all-time highs or near all-time highs, depending on which index you're looking at. It's because of all the money creation being pumped into the system. We also have most stocks owned by the top 10%. So essentially markets being ran and controlled by the ultra wealthy, the top 10%, the millionaires, not even the millionaires, the multi-billionaires basically are the bulk of the individuals in corporations, institutions, trading firms, hedge funds, etc., basically running the stock market. And when they decide to sell, that's when the markets will come down. But you really think that's going to happen this year in 2024, where every 4 years, obviously it's a year, every 4 years, that a lot of people out there, politicians, they want to keep their job. So obviously, I am expecting much more inflation, much more liquidity to be thrown into this economy this year to prevent any sort of crash or deflation. All right, but let's get into some numbers here. Let's just get it right out there. Let's talk about the numbers here. This is not my opinion. This is actually what's happening. Take a look here. This is the labor force participation rate. We're told that all these new jobs are being added. The jobs growth is awesome, is what we're told, basically paraphrasing, but it's unprecedented and awesome. Number of people not in the labor force right here. Spiked up in 2020, obviously, with everything that happened there. But look, we have not went down. In fact, the latest reading has us just over 100 million out of the labor force. Before 2020, we were down to about 95 million out of the labor force, which is still a lot. But where's the recovery? Where's the recovery? We're above 100 million still. We dropped below 100 million in September, or August rather, 2020. We dropped, if I could talk, we dropped below 100 million, and we dipped down a little bit further early 2022 down to about 99.2 million out of the labor force. So if everything's fine, if everything's improving, why are we back up over 100 million people out of the labor force? So remember, most of these people are not even counted as being unemployed. So it's manipulated data, flawed data, coming from the BLS, amongst other institutions, coming out of the Fed, the central bank, making people think that everything's actually fine. But all you have to do is look at a few different data points here. Let's look at this and look at the total debt here. This is outrageous. 17.3 trillion, and the fourth quarter is even worse. This is just the best chart that I've got here. This is as of the third quarter. It got even worse. But look at this compared to 2008. People thought that 2008 would never happen again. That was a bubble of unprecedented proportions, over $12 trillion. Now, folks, we're about 30% higher than we were in the amount of debt before, but yet people still think we're not in some sort of bubble. And just because it hasn't went bust doesn't mean that it's not a bubble. It just means that they're doing more to keep this bubble inflated than they did the previous bubble. Remember, the previous bubble, banks stopped lending. Right? This was before the TARP. This was before all the rescue programs, all the liquidity being pumped into the banks to rescue the banks, you name it, right? So a lot more is being done this time to keep the bubble inflated. And if you just look at the national debt, it's exploding 100 trillion, or no, 1 trillion every 100 days. I almost said 100 trillion every day. Wouldn't be surprised me if that happened in the future, but right now it's 1 trillion every 100 days, which is a lot. So that's over 3 trillion a year, and it's insane. 3 trillion a year. Over a 4-year period, you're talking about 12 plus trillion dollars, record breaking levels of debt accumulation. And again, this is borrowed money, money that they can just create at the click of a mouse and throw it out into the economy. Even with all the money being thrown into the economy, we still have to have many rescue programs just so people don't get pulled underneath the wheel, so to speak. We have FHA out there rescuing mortgage borrowers right now. Just look that up. We talked about that, 2 weeks ago. We have student loans, debt being forgiven, um, repayment plans being implemented to help these people. Look in 2020. In 2020, we had instantly 7+ million people that needed foreclosure forbearance. And if that didn't happen, you would have witnessed a housing bubble going bust much faster and much worse than 2008, because just the number of people that used forbearance exceeded all the foreclosures that we saw in 2008, 2009. So, right, so this economy is being propped up. Don't make any mistakes about it. But yet, I still see people down in comments saying I'm wrong. And the craziest part is people are saying that I predicted a crash. No, until you shut off the money supply, you're not going to see a crash. So anyone that says that or saying that I said that, you know that they're crazy, and they're probably actually not even watching the videos. Maybe they watched the video I put out a few years ago, but you have to keep up with the news, and you have to keep up with what's happening with the money being pumped into this economy. And of course, every day we look at new data, new charts. I shouldn't say every day because I didn't put out a video yesterday. Let's get into some other news here, because there's a lot of things happening here that I want to bring to your attention. And here's the latest on the credit card debt here. Credit card debt, a staggering $1.13 trillion. And the article goes on to say the obvious, right? Cost of living is driving people to put more and more expenses on their credit card. And this continues, and it will continue. Do I think the credit card companies are going to drop the credit limits this year, even though delinquencies are spiking? It went from 3 to 6% just in the past, year in one quarter. I don't think so, because again, this is a 4-year period. Every 4 years, we have a group of people out there that want to keep their jobs. And do you think they're going to allow the banks to do this? I think the credit card companies, the banks, they're being pressured to keep the money flowing, to not drop the credit limits, to not drop the credit ceilings, even though defaults are more than halfway to where they were back during the financial crisis, right? So things are escalating, getting worse, but they're going to do more and more to keep this thing propped up, right? So it's going to take something wild and something unprecedented. Just think 2020. It's going to take something big to stop this inflation, to stop the markets from going up. I expect more upside in the stock market, but I'm also hedged, because if something big does come in and drop this entire economy, then you're going to want to wish you had some cash to buy up some assets if we do see the drop. But I think the odds of that are lower than inflation. Again, nobody knows. So all you can do is really play the odds. Maybe you know exactly what's going to happen, and maybe you're positioned for all inflation, or maybe you're positioned for all cash, waiting for a crash or deflation. If you are, please let me know down in comments, but I know none of you are. So I'll still read your comments, but I know none of you are, because nobody, unless you work for the central bank or have some sort of inside connection, nobody really knows, when these things are going to happen, how it's going to happen. So what I would say is prepare for both, right? Stack hard assets. So some of you today are looking at your trades, you're looking at your portfolios, and you're up a lot. There's a particular trade that I said I was in but about 3 months ago, and it just doubled today. So congratulations to those of you that got in on that, and it's exploding. There's a lot of money being pumped right now into alternative assets, and I would say don't be greedy. Take some off the table. I just took another 10% off the table, and if it goes up more, I'm going to continue to take 10% off, 10% off. If we see it triple, 10% off. If it quadruples and beyond, then I'm going to start taking bigger chunks off, because then your gains are so big that it's worth it to take a whole bunch off the table at that point. But anyways, let's go ahead and get into some other information here. Let's talk about the worst states for credit card delinquencies. Let's see if we can bring up a chart on this here and bring it up on the screen. See if I can make it smaller here. The worst states in the South. What's going on in the South? Texas, 25%. Oklahoma, 28%. Arkansas, 30%. Mississippi, what's going on there? 39%, the leading state. People always assume that the delinquencies will be the most in the more expensive states like California and Hawaii, but it is the South, because a lot of it has to do with jobs. And even though the cost of living is cheaper in these states compared to some other states, look at Illinois. Illinois, with the high taxes there, is only 17%. And it also has to do with how many rescue programs are put in place to give out to the people that are really buried in debt, folks. So just think about these things, as we prepare for what's headed for us this year. I do expect some big things to drop this year as far as news and situations, systems going down, and be on the lookout for a lot of news. It's really going to throw the markets a curveball, and I just want you to be prepared for anything here as we head into the end of the first quarter here, at the end of the month, and into the second quarter, third quarter. Things are only going to get crazier, and we're going to be here on top of it for you. Everybody, please give us a like if you like what we talk about here. Come back for more. I'll be reading your comments. As always, keep stacking. Bye for now. Peace.